Now, you all have seen a notice like this: 70% of retail accounts lose money when trading spread bets and CFDs with this provider. Retail clients, on the whole, lose money. The majority of them lose. Now, whether you're an optimist or a pessimist, you'll read that statement differently. So when I met Bill Lipschitz for my very first book, when I wanted as a student to learn how to trade, and he's global head of foreign exchange trading at Salomons at the time, remember, so he's one of the world's biggest traders, I said, well, what kind of percentage return should retail clients get? And he gave me a number, and I'll tell you what that number is in a second. And I published it in my book. He was a percentage return he was happy to stand by. Let's work through how we might get that number. And it's his number, not mine, of what he thinks retail clients might be able to do. So I worked through it at the time, and I said, well, okay, let's assume we only do 25 trades per month, because we're going to get rid of the notion that the more you bang your keyboard, the more magic money comes into your PayPal account. It doesn't work like that. Okay, so you only do, say, one quality trade per day, basically. Let's say you're losing 1% on any one trade. Therefore, you've got 15 winning trades making 2%, because you want a strategy where winners add to winners. You're adding to your winning positions. You make more when you're winning. You're losing. If you don't have a strategy doing that, you don't have a strategy. Don't get in the game. Okay, so you've got 10 losing trades. And even those numbers are optimistic, because you're assuming you're better than a 50-50 coin in terms of being right and wrong. But bear with me for a second. Then you've made 20%, which is 30% minus 10%. Okay, if you've got £2,000 or $2,000, then you've made 400. Don't worry, it's over optimistic. We'll turn it down. Let's get pessimistic and conservative. If you made only half of that, that'd be £200 in a month, which would work out at about 100% per annum. Not my numbers. That's the return Bill Lipschitz said private investors should be getting themselves. Of course, when they get into billions, they'll have a separate problem, which is they can't get 100% per annum. With a billion, there isn't enough liquidity in the market to invest in the kind of trade, the kind of products they'd want to. So that's a reason why everybody doesn't get 100%, particularly in institutions. There's another reason. That's too much risk for an institution. Nobody would, in my hedge fund, none of the investors like Aegon, AXA would give us money if we were taking that level of risk. They just wouldn't. Okay, so what are you left with? Well, you're left with, as a private investor, you get the benefit of being able to take more risk and try and target a higher return. You get the downside that it isn't scalable for you, but it's a nice problem to have anyway. Not my numbers. Don't hate me for the 100% return for a private investor, but the numbers are Bill Lipschitz, and so he went through it in my book. The book is free to download. There's links in the biog for that.